Hello, this is Richard C. Wilson at the Family Office Club. Today we're doing a member spotlight interview with Pratik Sharma from Bridge Tower. Welcome, Pratik.
Hi, Richard. How's it going?
Good. How are you today?
Doing well, man. Doing well. Thank you.
Great. And can you tell us a little bit about Bridge Tower and what you do?
Yeah, Bridge Tower is a vertically integrated single-family rental asset manager. We have 1,700 doors across Texas, primarily Dallas, Houston, Austin, as well as and an additional 300 homes under construction in Charlotte. Our returns have matched or slightly lagged the total return of the S&P 500 since inception in 2013.
Okay. So just off the top of my head, you guys underwrite, we'll talk about what's going on during the pandemic in a second, but normally are you underwriting returns for investors at kind of that 8 to 10% a year type return, or what's kind of the ballpark of what you aim for?
Yeah, so we the threshold for us to actually pencil a deal is we look to underwrite to a 6 cap, and then we use very conservative leverage. So we'll typically do 1/3 equity, 2/3 debt. And so the total return over time when you factor in home price appreciation, which we conservatively use maybe 2.5% a year in the Dallas-Fort Worth area, that's very low. That total return winds up being 11.5 to investors annualized.
Okay, great. And obviously it's relatively low risk strategy compared to new real estate development or, biotech or venture capital, et cetera. So I'm sure that's part of the reason why you've been able to grow to 1,700 homes. What do you think is really your value add process that's allowed you to scale to that level? Because I've heard of many firms that do what you do and they have 100, 200, 400 homes, but it seems like you guys are really getting to scale. You must be doing a few things right all of the time to kind of keep on growing.
Yeah, so this is kind of that question that people typically ask, like, what's your edge, right? Like, why are you better than the other guy down the road? And I'm going to liberally paraphrase Howard Marks from Oaktree over here. One of his recent write-ups, he basically talked about the rules of games of chance with actual investing, right? And the key fact was, how do you make better decisions, right? And just because you make a better decision doesn't necessarily mean you'll have a better outcome, but it increases the likelihood that your outcomes will be better over time. And so the three factors that kind of really weigh in to making better decisions are either the existence or non-existence of information and information asymmetry that may exist. Then there's luck, and luck is fickle, obviously. Sometimes it's on your side, sometimes it's against you. And the third is skill. And in the single-family rental real estate market, once you get above a certain size, there is no real information asymmetry. Yeah, sure, the mom-and-pop operators don't necessarily get the same look at deals that we get, but once you get above several hundred homes, everybody's looking at the same set of data. And like I said earlier, luck is fickle. So it really comes down to skill of operation. And we are value investors at heart. We definitely look to build in a massive margin of safety whenever we come in. And we built with the future in mind. So basically, a lot of the technology and systems that we use to operate our portfolio is typically what you would see in these large multifamily developments. You don't really see that in single family. We brought that into single family. So as of now, we basically need one FTE to manage about 150 homes, which is a lot better than our competition. So it's really just conservative approach, skill of execution, leveraging technology to its full scale, and then executing and sticking to your core principles. Okay.
Interesting. Do you have any portion of your portfolio that's Airbnb, or is it all long-term rental, or do you do extended rentals for executives?
Oh, it's interesting you asked that question about Airbnb, because that actually talks to kind of one of our edges, if you will. No, we do not do any short-term rentals. These homes are workforce housing in urban infill areas, roughly 20 to 25 minutes from downtown. They're about 1,800 square feet. We build them from scratch. About half the portfolio is that way. The other half is legacy project or product that we acquired. We have a private equity partner who has committed $100 million in equity to us to do certain projects, assuming it meets their thresholds. They reached out to us and asked us, why aren't you guys doing Airbnb? The IRRs are through the roof on this thing, So we actually took the time to see, okay, how does it work? What's the churn rate? What do you need to do in terms of specialty services? What are the commissions to Airbnb, and so on and so forth? And it turned out the deal only penciled properly if you assume pretty rosy condition. right?
Right.
And so we passed on it. And just yesterday, the Airbnb announced they're laying off a quarter of the workforce. All of these
Right.
super hosts who built these mini empires of real estate, we'll probably be dealing with them in the future, but most likely in the foreclosure process, 12 to 18 months down.
Right. Right. Yeah. Interesting. And how have you been scaling your firm? I know some groups in your space have a fund, and they do a fund and then another fund 18 months later, et cetera. Others allow people to come in on like a group of 50 or 100 homes being purchased at a time.
Mm-hmm.
How have you decided to structure? Is there one option? Is there multiple options for investors? I'm just kind of curious how you've put that together.
Sure. So, we basically have two groups of investors, or two different investor profiles, right? So for the individual, high net worth individual, we have a separate limited partnership set up, and we've just launched our ninth LP. And then for institutions or a family office that wants to commit, a meaningful sum of capital, we would do a special purpose entity just for them. And our focus right now is really on the build to rent side. The yields are exceptional. And then when you're looking to operate a portfolio for a decade plus, when you design it and build it yourself, the operational expenses over time are so much more manageable. Plus,
you know where to find that extra door handle, that extra, whatever that breaks, right?
Well, you standardize fixtures, you standardize design, and that's kind of what we're doing in response to the pandemic. Plus, your roof doesn't break or leak within its first 5 years. Your refrigerator doesn't break within the 5 to 7 year period. So your your initial ramp up process is a much more efficient.
So you're capturing the arbitrage of developing single family residential, but you're also lowering the costs because you're buying in bulk light fixtures, and you're reducing your headaches of a pipe bursting, insulation being poor, water heater, whatever, right? Causing you a pain, right? So you're lowering costs and increasing. I guess the trade-off is dealing with construction financing, the patience to develop until fully developed, getting land titled or getting land that's already titled. I guess you have to gain some new capabilities as well to be able to pull that off, right?
Yeah, well, in 2014, we basically integrated an in-house construction company. And so the leader of that firm is a 40-year experienced veteran who used to run a $3 billion book at Guaranteed Bank. So he knows how to deal with developers, getting lots, negotiating prices properly, setting up design for rentals, which you may not think it might be slightly counterintuitive, but home design for rentals versus for ownership is actually quite different. And the stuff you put inside really makes a difference, and it makes it's like, how do you create a more attractive product for your end user?
That's durable as well, I'm sure. Interesting. Well, let's get back to the questions I was meaning to ask you. I was just kind of more curious, digging into a few of those things there. What would be the number one due diligence question somebody should be asking someone such as yourself? And maybe you get this question sometimes, maybe nobody ever asks you it, but they should be if they knew what you knew. What's that number one question?
It's actually what I would tell any investor right now who's looking at single family rental real estate, and it's a very fragmented market. I mean, there's 15 million single family rental homes. About 2 to 3% of those are owned by institutional managers like ourselves. The first thing I would tell somebody is ask your investment manager, how much are they investing on an annual basis in their operating company? Because a lot of this trend really started probably in 2012, 2011, post-great financial crisis. And at that point, the valuations were, you could basically, even if you didn't operate efficiently, your just home price appreciation and that arbitrage that you had just from buying in distress, basically everything would be fine. So a lot of groups came out that didn't really build a operating company to actually manage and own and maintain and lease and service these properties. So how often are they investing? How much are they investing? And what are they investing in? Are they investing in more salespeople, more tech, things to that effect? So, we are very, very heavily leveraging technology across the board at our firm. Going virtual was not a problem because we were born virtual and got an office a year or two afterwards. So.
Right. And how's rent collections been going during the pandemic, like in March and April?
So March was actually great. It was 97% of people paid. There were some late payments, but they had late fees and everything else. So 97% paid. April, the numbers are still trickling in. If you had to hold me to a number, I'd say we're probably in the high 80s. But until the 10th, I don't think I can say with confidence that we won't exceed that to get into the low 90s. And that would still be considered, given the environment. I feel good about that. And I think that's a tribute to our operations team who proactively reaches out to tenants. Hey, are you going to have trouble? How can we work this out? Would it help you if you paid half in cash, half with your credit card, things to that effect. And so, that builds customer loyalty, but at the same time, make sure that, the revenues continue to flow so we can meet our obligations to our lenders and to our investors.
Yeah, that's smart. That's smart. I know my landlord just reached out and said the opposite. It's like, oh, full rent is due. So make sure you pay on time, and which we did. Yeah. But I imagine that's a tough letter for some to get. I bet some were like, well, good luck getting it from me because our business is shut down, et cetera. So
it's amazing, Richard, the human aspect. It's like kind of the golden rule. Just be a decent human being. We don't send letters. Right. We call and say, hey, how you doing? Everything all right? I mean, people want to work with you. Nobody, despite what some people say in the media and on the Twitter sphere and everything else. Americans aren't deadbeats. Americans aren't lazy. They want to work. So people want to meet their obligations, especially for their home. They want to do it with dignity. And as long as you can operate with that mindset, I think you'll over time go much further.
Yeah, no, I agree. So what's the last question here? Your $100,000 piece of advice for anyone looking to invest either in real estate or single family residential rentals or in real estate developments? You've learned a lot there probably. What's something that you wish you knew a decade ago?
Wow. The decade ago question's kind of thrown me. I was thinking that the $100,000 piece of advice that I have right now is you have to think, what kind of world are we living in on a moving forward basis? So I look at multifamily constructions at a 33-year cyclical peak. And how many people actually want to share elevators, common spaces, and that sort of thing with others, given, the unknown nature of how this virus spreads and, we don't know when it's going to be over, whether it's 6 months, 6 days, or a year and a half. And so I think single family homes are definitely an attractive place to be, and especially on the rental side because it gives people the flexibility. But the main thing I would say is that, as a student of history, and I wasn't born in 1971, thank God, but if you look at the 70s as an era, I think we're probably coming back into a similar kind of macroeconomic situation, which probably, I guess you would describe it as stagflation. So you're going to have low growth, inflation, and you can see it in the commodity situation right now. You basically have not a demand pull inflation on that side. You're really seeing it more on the production's been shut down. And so in those types of environments, real estate does really, really well. So I think align yourself with a good operator, somebody who really invests in the business, operates for the long term, isn't looking to flip things and make a quick buck, and somebody who's really got a lot of skin in the game.
Right. Great. I appreciate you sharing that. It amazes me how many investors I know who invest in fix and flip or their own little private lending, hard money lending thing, but it's to a guy doing like one house a year or 3 houses a year. And it's like he has no team. He's got a couple 1099s and it's not professionalized at all. And it plays several bets with people like that. And in their mind, they've kind of diversified risks. But in my mind, it's like with all low quality, non-professional, non-proven, groups. And, everyone has to start somewhere. So obviously at some point I had no team. At some point you had no team, I'm guessing. Yes. So everyone starts somewhere, but picking those people early on, you have to be extra careful, I think, because you don't know if they can walk yet. You don't know if they can survive in the jungle and, do well by you. So I just think a lot of investors should be a lot more careful, with such things. And we find that a lot when we engage with them and start their family offices. So,
that's the lesson that I'm taking. The only documentary I've watched during the pandemic, I have not Netflixed and binged anything or Amazon binged anything, but I have watched The Last Dance on ESPN, talking about the last year the Chicago Bulls won the championship. And, one of the takeaway is almost identical to what you just said. It's like, sometimes it's just, you need to have that one key component, the right team, discipline, focus, and execution. So going back to our edge, we're not as unusually lucky. We don't have access to any special information that other people don't, but we have discipline, we have skill, we have a process, we repeat it, and we scale it.
Right. Great. Well, it'll be exciting to watch you grow further. Thanks for being part of the Family Office Club. I'm happy to keep in touch and see if there's any investors we work with or people in the Family Office Club that see some opportunity to joint venture with you or something else. What's the best way for someone to get in touch with you directly?
They can connect with me on LinkedIn. That's an easy way. Or they can email me at partners@bridgetowergp.com. I'm very, very accessible. So LinkedIn or partners at bridgetowergp.com, and you'll get a pretty quick response from me.
Okay, great. Well, thank you very much.
I appreciate it, Richard. Thank you.
Take care. Bye.